is citing weak demand factors. In this report, we aim to shed light on the factors driving WTI's price and assess future outlook. An OPEC Plus ministerial meeting took place on Wednesday, in which the group made no changes to the group's oil output policy, which may have provided support for the price of the commodity, yet that appears to have not materialized. Furthermore, following last week's statements by Russia that they will be sticking to their original agreement with OPEC Plus to reduce oil production, the liquid gold edged closer and closer to the $100 per barrel, one figure, but since the beginning of the week, it appears to have reversed trajectory and moved lower to levels last seen at the end of August 2023. In addition, it appears that the external factors, such as demand, may be mitigating the production cuts of OPEC+, such as demand-side worries, which may be counteracted against the group's aims of preserving oil prices at higher levels. Lastly, we personally believe that any attempt to increase oil production cuts from their current levels may be met with fierce opposition from nations who have repeatedly expressed discontent and desire to increase oil production, such as the UAE. Therefore, we believe that the group may not be able to cut production further and that the price of oil may be dictated by other factors. On the other hand, should the group announce further production cuts, we may see the commodity gaining support. During yesterday's American session, the US gasoline inventories figure came in at 6.481 million, a much greater increase in inventories than the expected figure of 0.161 million. The greater than expected figure marks the lowest level in a seasonal gasoline demand since 1998, according to Bloomberg. The implication of a reduction in demand could be that the high inflation rate in oil prices could be greatly affecting the disposable income of consumers. Furthermore, a reduction in demand could potentially reflect that the current prices of oil may not be sustainable and could be indicative of deterioration in economic activity in the US. As a result, the reduction in demand seems to have heavily weighed in on the price of the commodity, as concerns about a potential recession appear to be re-emerging following a relatively quiet period of no major concerns of a major recession. However, we should note that despite current concerns emerging about the US economy, the reduction in demand could be temporary, and as such, the current implication may be more of a short-term view. According to Bloomberg, international oil companies are stating that they're facing $1 billion in losses as the dispute between Turkey and Iraq over a closure of a key crude export pipeline continues to be prolonged. A separate report by Reuters stated that Turkey was ready to restart operation of the pipeline during this week, yet it appears that may not be the case, as the issue over damages owed to Baghdad by Ankara still persists. Despite the current issues, the pipeline has already been closed for over 6 months and as such may not heavily influence the oil markets. However, should it be reopened and the supply of oil into the international markets is increased, we may see the price of oil weakening. On the other hand, should the pipeline remain closed, we may see some support in the oil markets, yet we believe that in such an event, the potential support for the commodities price could be minimal. Thank you for watching.